What's crazy about this year, the stocks are all over the place. There are stocks that are up here, there are stocks that are way down. Give us a synopsis of the year. Who's done well, who's not done well, and why? Nigel Coe of Wolfe Research, who covers the entire industrial sector.
Anything touched in the data center right now is growing very fast. And if you're not touching the data center, you're probably not growing that fast. Stocks like Eaton, nVent, Vertiv, Wesco. And they're growing organic sales of 5, 10, in the case of Vertiv, 15%. So that's a lot of growth.
You're talking about sectors that historically have backlogs of 2, 3, 4 quarters, now have backlogs of 3 to 5 years. They'll get this stuff built by 2028. The question basically is, can they plug it in?
Can they plug it in? That's right.
Let's talk housing a little bit. Housing sucks.
Yeah.
What are you hearing from your companies? Is there any hope?
Down 10% this year, so probably flat next year.
We're like 3 to 5 million homes short.
Right.
So what do you think of your group going into next year? I mean, it's kind of a K-shapey economy. If you were sitting with an investor right now, what would you tell them to focus on? What would you tell them to worry about? Hi, this is Steve Eisman, and welcome to another edition of the Real Eisman Playbook. Today, we're going to be interviewing Nigel Coe of Wolfe Research, one of my boutique firms that I really appreciate, who covers the entire industrial sector. Now, let me explain what that means. That's like saying you cover all of financials. You know, when you cover all of financials, it's banks, it's asset managers, it's payment companies. It spans the gamut. Nigel has a very, very broad coverage. So first of all, welcome, Nigel.
Thanks, Steve.
To the Real Eisman Playbook.
Pleasure to be here.
So let's break it up first. You cover a whole bunch of stocks. Before we even talk about like what's going on, group them for me. How do they arrange?
Okay. So as you mentioned, the industrial sector is very wide, very broad. So you've got a lot of big machines with wheels like Caterpillar, Deere. I don't cover any of that.
You're not a machine guy.
I'm not a machinery guy.
Okay.
So think about my coverage as being the old school conglomerates. So if you remember back in the days of GE, ITT, Rockwell, all of those big diversified industrials, these are the legacy, these are the successor companies of those conglomerates. So
they broke, all the conglomerates sort of split apart.
Conglomerates were very 60s and 70s. Diversification was in at that point. And now it's much more a focus. But as a result of that, we cover a very broad array of end markets, a lot of different verticals and industries. I'd say if I had to group 4 or 5 of the most important verticals, it'd be A&D. It'd be
what's A&D?
Aerospace and defense.
Okay.
Electrical equipment, HVAC, air conditioning companies, industrial automation would be the major categories.
Big 4.
The big 4, yeah. And then beyond that, there'd be a lot of manufacturing, building products, residential construction, things like that.
So what's crazy about this year is I was just looking at your group in terms of performance. The stocks are all over the place. I mean, there are stocks that are up here. There are stocks that are way down. And some of the companies that traditionally have done well, like Eaton, have not this year. So give us a synopsis of the year in terms of groupings, like who's done well, who's not done well, and why?
So I would say if I have had to give you a soundbite, we've got pockets of growth, and then we've got a lot of no growth in the industrial sector right now. And anything touched in the data center right now is growing very fast. And if you're not touching the data center, you're probably not growing that fast. So if you go back 10 years, I would say the big drivers of performance would have been valuation and quality metrics like high margins, higher ROIC.
So basically, boring.
Boring was good.
Okay.
Now, because we've got these pockets of growth has become much more important. So organic sales growth in general has become a much bigger driver of divergence in performance. And of course, EPS momentum is very important as well. So if you've got growth, then you probably have EPS momentum.
You know, I remember talking to one of your peers about like 10 years ago, and he would say something like, if we could get 2 to 3% of revenue growth, that would be good.
Okay, so I'd say the companies that have the data center exposure would be stocks like Eaton, nVent, Vertiv, Wesco, and they're growing organic sales of 5, 10, in the case of Vertiv, 15%. So that's a lot of growth for industrial
And just
companies.
Vertiv, it was created by the former head of Honeywell.
Yes. Yes. So Vertiv was sold by Emerson 10 years ago.
10 years ago.
10 years ago in 2016.
Okay.
Is in PE for 4 years. And then Dave Coe, the chairman of Honeywell, ex-chairman of Honeywell, bought it out of PE as a SPAC and created a lot of money for himself and others, for sure. He's done well. So certainly data center exposure is a big driver of growth. But then we have other areas like commercial aerospace. If you remember, commercial aerospace was absolutely laid low by COVID, the lockdowns.
Laid low. It was obliterated.
It's a complete smashed. I mean, we had I think 90% reduction in flights flown.
90%, right?
90%, which that never happens normally, and we're still recovering from that period of time. So commercial aero and defense with all the military budget spending happening outside the US, that's another pocket of growth. And then we have other areas like power generation. We were talking about power generation before we started here. And then beyond that, commercial HVAC would be another area of growth as well. Outside of that, Steve, I would say the no growth is really the anything touching the consumer.
So Stanley Works.
The residential HVAC companies like Lennox, Carrier are seeing negative growth right now.
Negative.
Yeah.
Okay. So let's go back to AI. Some of the companies that you mentioned have done well. nVent this year, Vertiv, and yet Eaton, which is a company that has done well for years, has not done well this year. What happened to Eaton?
So
a superstar of the group for years.
Absolutely. Absolutely. And by the way, I mean, the order growth and the backlog expansion for Eaton has been still pretty good, but it hasn't been at the same level as some of the other companies. And the reason for that is that Eaton still has some legacy businesses that are right now down, have negative growth. So for example, they've got 2 businesses that sell into Class 8 trucks, so heavy-duty trucks in the US. That business this year is down probably mid-teens.
And is there a reason for that?
Right now, the underlying economy is quite weak.
It's just not that great.
It's quite weak. Right?
Okay.
And we've had several years of strong production of trucks, and we're now seeing a correction around that. And then they've got an automotive business, which has been pretty flat. So that's one reason. The other reason for Eaton specifically is that, and this is actually a good reason, really, is that they're expanding a lot of capacity. They're putting up 12 plants in the US. Now, when was the last time they constructed 12 plants?
Never.
You have to go back 40, 50 years, and maybe not even
So
then.
just to repeat that, so Eaton is creating 12 new production plants to manufacture what?
Transformers, switchgear, data center equipment.
So AI power related.
We have to rebuild the power networks, the power generation, the transmission networks, because they're decrepit, and we're seeing a massive increase in power consumption right now. And a lot of that's data center related for sure, but we also have heat pumps rising. We've got EV penetration increasing. We've got electrification of heat as well. So there's a lot of demand for power. So a lot of it's to do with that. And then, of course, the data center equipment they're supplying is in strong demand right now.
So I always had a question because Rockwell is called an automation company and Eaton is called an electrification company. And I never could keep it straight. What's the difference and who's doing well and why?
Well, they're both doing well for different reasons.
What's the difference between automation and electrification?
Automation is, in very simplistic terms, taking a piece of manual labor and having the machine doing that, or having the machine helping the manual laborer do that process faster. So a classic example would be a widget going across a line where you have a sequence of workers doing something to that widget, and you kind of take that away, and you have a conveyance system that will do things with it with a robot arm, etc. That would be a classic automation system. Electrification would be an example of electrification would be taking a gas boiler and replacing that with an electric heat pump. That's one example of electrification. Another example would be you filling your traditional car with fuel. You replace that with an EV. You got to charge it. That's an electrification.
So why is Eaton a beneficiary of AI?
Eaton is the largest supplier of electrical equipment in North America. So their market share is about 30%. They supply into every single end market, commercial building, industrial facilities.
So any data center that's being created is going to use Eaton stuff.
They are one of 3 to 4 big players of power equipment in the data center.
Who else?
Vertiv, Schneider Electric. And then you've got other players like ABB and Siemens would be there as well.
And what's an nVent?
nVent is much more around the rack. So if we dig a little bit deeper, we've got the gray space and the white space.
Okay, let's elaborate on that.
The gray space is the electrical equipment that comes in. So you have utility power. It comes into the building. You then distribute that power through the building. That's the gray space. The white space is more the IT equipment. And where nVent plays is more the cooling around the rack.
IT equipment. And Vertiv does that too.
Vertiv does that as well. Vertiv is the largest player there. But there you have Vertiv, you've got nVent, and you've got 1 or 2 other players there as well.
So let's just dig down into what you like right now, just in this space. What's good? What's not that great? Just in this AI kind of related world.
In this world, so Steve, I figured out pretty quickly that what drives stocks is EPS revision. So if EPS numbers are going higher, there's a good chance that stock's going to outperform the sector. And so where I see numbers moving higher, I think it's nVent, Wesco, and Vertiv. Now, those are the 3 stocks where we have outperform ratings within that space. Now, obviously, valuations are rich right now, but so long as EPS numbers are moving higher, then the stocks will probably work. Where I see...
Well, by the way, just to interrupt you for a second, completely agree. In a bull market, people just care about the story, and is the story getting better? And if the story's getting better, the multiple's just not that important to most investors.
Exactly right.
Bad times, EPS revisions come down, all of a sudden everybody say, oh, the valuation sensitive.
In that scenario, reverse everything I just said.
Exactly right.
Yeah. And then you mentioned Eaton's EPS numbers just haven't moved higher. And I think that's a reason to stay on the sidelines for now. And then we have better visibility on an inflection. The valuation of Eaton actually looks very interesting here.
It does.
It does.
All right, let's move on a little bit to one of the last great, or maybe not so great, conglomerates, Honeywell. What's going on there, and what do you think about it? This is not a short story.
This is not a short story. And we've got, another half an hour or so? We could spend half an hour talking about Honeywell.
Easily.
Yeah. So I think we touched on the fact that a lot of my companies used to be conglomerates, and they're now more focused companies. And there's a lot of good reasons for that. And Honeywell has been divesting businesses over time, but they still are very diversified. So Honeywell's going through a breakup process. We've had a CEO change in the last couple of years, so that's one reason for that. The other reason is an activist, Elliott Management came in and made some suggestions, which the board considered, and they decided it was a good idea.
Which was what?
Basically breaking out the aerospace business. So today, Honeywell
is composed of what now?
Honeywell today has a building automation business. It has an industrial automation business, and you've got some what they call performance technologies businesses, which are, I'd say specialty chemicals businesses like catalysts and LNG equipment. And aerospace, and of course
aerospace is the biggest division.
Honeywell, that's about 40% or so of their revenues today.
Okay, and so they're going to break off aerospace.
That's spinning out as a pure play aerospace business.
Okay,
and of course you look at what happened to GE.
I hadn't noticed.
Yes, well, we used to talk about GE a lot back in the day.
I can recall meetings where I've had with, industrial analysts like yourself, where 90% of the meeting is what's going on at GE, and then everything else is sort of a sideshow.
Yeah. I remember I walked into your office one day, and because GE was so complex at that time, I had a 30-page deck just on GE.
You had a 30-page deck?
A 30-page deck.
On one company?
Just on one company.
By the way, that was my thesis as to why you couldn't own GE. I said very simple. own this company, you need to be able to write a dissertation, and nobody wants to be able to write a dissertation.
Then that's what he told me. He said, I can't own a stock where I need a pitch deck to understand what's going on.
Exactly.
So, and again, another thing I learned very quickly in this space is investors like simple stories.
Right.
And
or at least stories they can tell within 5-10 minutes.
There you go. So G had to become a simple story. And the easiest way of doing that is to break yourself apart.
Right. Let's talk about power, and let's talk about GE Vernova, which you're not recommending. I'll pat myself on the back a little bit. I bought GE Vernova about 2 years ago, so lucky. So let's just talk about, you do touch upon power in various ways, and you do cover GE Vernova. You just told me you were at this data center conference. What happened at the data center conference? What was the power conversation? And let's turn to GE Vernova and anybody else you think is relevant.
Yeah. So there aren't, if you want to play power generation, you probably want to own a utility because they actually produce the power. But what GE Vernova does is they are one of the 3 big turbine suppliers to the utilities.
Now, who are the big 3?
The big 3 are GE Vernova,
Siemens,
and Mitsubishi.
And
then beyond that, you've got a tail of smaller players like Caterpillar. But Caterpillar doesn't provide prime power in scale. They're much more backup power. The big 3 are the big turbines you see in these power generating facilities.
Where was the data center show?
It was let me get this right. Where was it?
Somewhere in the United States of America.
St. Louis.
St. Louis,
Missouri.
Oh, wow.
Yes. And because most of the trade shows happen in Chicago or Atlanta, so I had to dial back there, St. Louis. But the takeaways were very bullish. So you watch CNBC, you read the Wall Street Journal. There's a lot of angst, a lot of debate about, are we in a bubble? Are we in this AI hype cycle? Everything I heard last week from the folks on the ground, the salespeople selling this equipment is, customers want the equipment yesterday. There's backlogs extending out to 2 or 3 years, and there are projects.
And backlogs like in what?
Across the board. So power equipment, cooling equipment, the whole.
Everything you need to create a data center.
Everything you need to create a data center. And then there's visibility beyond that time frame as well. So we're talking about 4 to 5 years out. So,
by the way, in your career, have you ever seen anything like that? That kind of visibility, that long out?
The only visibility you'd have with that kind of time frame would be in commercial aerospace, where you have backlogs 6 to 7 years out.
Of planes?
Of planes.
Okay, and everything related?
Exactly right.
But other than that, never?
No. Most of my companies would have a backlog of, 2 or 3 quarters.
So let's just hammer that down for a second. You're talking about sectors that historically have backlogs of 2, 3, 4 quarters, now have backlogs of 3 to 5 years. Same business, same companies. That's pretty extraordinary.
Largely, yeah. So exactly right. So it's a different world, and by the way, it takes 2 or 3 years to build a data center. So part of it is we don't have enough supply to meet your demand right now. So you're on allocation right now. But then the other part of it is that we're going to be supplying this data center in Texas that's scheduled to go online in, say, 2028.
Right.
And it takes that long to build the infrastructure, and it takes that long to get the power. And as we talked about, the power is the long pole in the tent right now.
And when you were at the conference, what were people saying about power?
So the only concern that folks at the show had was power constraints.
That's their binding constraint.
That's the binding constraint, and that's the one.
So let me elaborate. So in other words, they'll get this stuff built by 2028. The question basically is, can they plug it in?
Can they plug it in? That's right. And now, if you're building a data center where there's power, that's fine. However, if you want to put a data center in Santa Clara or Northern Virginia, you might have problems getting the power. So what we're seeing is increasingly the data centers are going where there's the power.
And where is that?
Texas, the Midwest, and places like that.
The thing about Texas, though, is that in 2021, they had that bad winter storm, and they had to ration electricity. So one of my hopes for the whole sector is let's pray for mild winters for the next 5 years, because otherwise we could have some trouble.
Right. Absolutely. And of course, I think, one thing that we've learned is we need more reliable baseload power. So, one of the reasons why we're seeing this big gas renaissance, gas power renaissance,
which is GE
Vernova, is I think the folks that plan these grids realize you can't plan them on renewable energy and batteries. You have to have stable baseload power,
which is
coal,
gas turbines,
gas, and nuclear.
All the old stuff.
Yeah.
So let's talk about GE Vernova, because it was part of GE. It was moribund. It was an anchor around the. I mean, it's unbelievable what's happened to this company. So walk us through like the origin of GE Vernova. I think it was combined with Alstom. It is quite a story, and it was a disaster. And there's a slogan I always like to say: "Peacock today, feather duster tomorrow, peacock again." That's GE Vernova.
Yeah.
Explain to me what GE Vernova does and what happened here.
Okay, so GE, classic conglomerates, aircraft engines, power generating equipment, NBC Universal,
financial services,
big bank, insurance company,
right?
And all that has gone by the by. So now GE today is now an aircraft engine company, and then GE Vernova is the.
So just so everybody knows, there are three GEs. There's GE Healthcare. There's GE, which is aerospace, which is doing great. Yep. And there's GE Vernova, which we're about to talk about.
Right. And GE Vernova, talk about peacock today, feather duster tomorrow. This is exactly a great way to describe GE Vernova. So if we go back to 2014, they bought the French power company Alstom.
Yes.
And
they bet the company.
They
basically did.
Yes.
Immel bet his career and he lost.
Well, one of the issues was that GE, as you mentioned, had a big bank. And the compact with the bondholders was that the industrial company had to have very low leverage to support the huge debt that the FinCo had. And as part of the Alstom deal, GE started to take on more debt. And so the seeds of the problems that we saw in 2017 were really planted at that point in time. So that was one thing. And then Alstom had a lot of contingent liabilities, a lot of loss-making contracts. There were some legacy liabilities. So that's the only company, the only acquisition I've seen of that kind of size that had negative liabilities. So they acquired a business with, I think, $6 to $7 billion worth of negative liabilities.
Negative liability?
Yeah.
What do you mean negative liabilities?
Meaning that I think the acquisition, Steve, was about $13 billion in that sort of zone. The goodwill was $20 billion because they acquired net liabilities of $7 billion.
Whoa, okay.
Yeah.
So Alstom did the same thing as GE. The GE, they made gas turbines.
They made gas turbines, they made steam turbines, and they had a wind business, an offshore wind business, and then they had a huge transmission business. So when you think
What's a transmission business?
Okay, so you got a power plant, pushing that electricity to the grid. You got to step up that power to hundreds of thousands of volts. You transmit over grid lines, and then you step it down to power that we can use.
Right.
And what the grid equipment does is it steps up the power, steps down the power, and basically manages that circuit.
And hopefully doesn't blow anybody up.
Hopefully it doesn't blow anyone up. I think it does happen from time to time, but
right. But that's the goal.
That's the goal. That business today is great. So they did acquire some good businesses as part of that acquisition, but I'd say between 2015, the year after acquisition, to 2018, it was a nightmare for GE.
And why was it a nightmare?
So in 2017, and it wasn't just Alstom, the gas turbine market took a big downturn at this time as well. The power business, the GE Vernova business today, was burning about $3 billion of cash in that one single year.
2017.
So, 2017.
Wow.
So they had to go through a big restructuring process. They had to reduce a lot of capacity. They fired a lot of people. They downsized that business aggressively. So GE Vernova today is, the market cap's, well north of $100 billion. Back then, it was probably priced at negative value within GE.
And what year would that be?
I think, honestly, the business spun out from GE in 2024, early last year. I think the year before that is probably priced into GE stock at probably a negative value.
Wow. And now it's $100 billion.
Now it's $100 billion.
Because the world just flipped.
The world
for gas turbines.
The world for gas turbines. So taking a step back. So what's changed with gas turbines? So this time 5 years ago.
So just what people understand, a gas turbine is a turbine that is like as big as this building that you put in a utility building, and it creates electricity for people to use in their home or for a data center.
Exactly.
That's what a gas turbine is. It creates electricity.
It's the same principle as an aircraft engine in that you're pumping loads of gas in, you're spinning the turbine very, very, very fast. Obviously with an aircraft engine, you're creating propulsion to move the plane. Here you're spinning a turbine to create electricity. Yeah.
Okay.
You're right. These things, the large ones can pump out 400 megawatts of power. So they're massive. These are huge machines. But the market for gas turbines was the thought process was that we were seeing basically the market ebbing away because the power generation markets were moving towards renewables pretty aggressively. So wind, solar, and batteries.
Probably till 2021, 2022, there was no growth in electrical demand in the United States, maybe for 10, 15 years. So all you were doing was taking gas and giving it to renewables.
Yes.
But there was no overall growth. Now there's overall growth, and you need those gas turbines.
Exactly right. So again, if we were sitting here 5 years ago doing this interview, we'd be talking about total power capacity needs of about 10 to 20 gigawatts a year in the US. Today, that's 50 to 60 gigawatts. And the reason for that change is we've gone from a market that's, where power demand is growing at less than 1% 5 years ago to now close to 3% a year.
By the way, just so people understand, the fact that we're going from 1% to 3% doesn't sound like a lot.
Right.
But it's 3% of 4,400 terawatts.
Yes.
So you're talking basically 40 to 60 gigawatts of new power that needs to come on stream. I mean, these are just numbers that sound, but these are massive numbers. Massive numbers.
Yeah.
I mean, you don't make these type of new electrical demands just like, oh, we're just going to create a plant and just do it. I mean, this is massive infrastructure.
Correct. And the thing as well is you're planning the grid on peak demand, right? So the point where you're flicking on lights or turning on the TV and
bad winter,
everyone flicks on their heating at the same time. Now you've got these data centers that are running 24/7. So
correct.
You're adding, let's say, 10 gigawatts of data center capacity that are running 24/7. So
a year. Right. At least.
Yes. So you need baseload dependable power that data center can't go down. It has to run. So that's why we need...
number one, it can't go down. And number two, people can't freeze to death at the same time.
There you go.
So you need both.
So
if you're adding 10 gigawatts, you probably need to add more than 10
You're
gigawatts.
adding more. You need a
need a cushion.
Safety. Exactly right. Yes. So that's what's changed effectively is that and it's not just data centers. It's also heat pumps. It's EVs.
It's everything.
It's everything.
Okay. So when you talk to GE Vernova, what are they saying? They must sound like we can't believe our good fortune. What do they sound like?
What they're saying is that they have visibility well beyond 2030. 2030. So the question for them is, it's not so much a case of, do we have the demand? The question for them is,
when can we meet it?
Right. Do we want to push price or do we want to add more capacity?
And what are they doing?
Well, both.
They're doing both.
They're both. They're adding capacity, but
they must be a little gun shy given their history.
Correct. They really are. So they know that
because they know this stuff could just go away.
It can go away. Yeah, and it probably isn't anytime soon. But the last thing you want to do, because it takes so long to add capacity, it takes 2 or 3 years to add capacity.
So explain that. So in other words, if GE Vernova wants to build another factory so it can build more turbines, you're saying it takes 2 to 3 years from today where I say we're going to build it to when we actually built it for that thing to come online. That's 2028.
Yes. You got to order the machines. You got to bring the machines in from overseas. You got to add those to the plant. Also, a lot of the supply chain are supplying machine parts. So they've got our capacity as well. So you got to get all your ducks lined up. It takes a long time to do that. So yeah, maybe 3 years is too long, but certainly 2 years would be the right time.
Let's talk quickly about 3M. because that's a feather duster now Peacock. It's a 3M had a whole bunch of legal issues.
Yes.
They got a new CEO. They got rid of their legal issues. Just tell us what 3M does and why they're doing okay these days.
So 3M is
And the only thing people think about 3M is the yellow sticky pads.
The sticky pads, yeah. The sticky pads, the command strips that go on the walls.
Right.
They do a variety of products. They've got 50 plus technologies. So think about grinding applications, sandpaper. They do industrial grinding. Adhesives is a big drive for them. So obviously the adhesives on the sticky pad, but then they've got industrial scale adhesives that go into iPads. So think about what keeps your iPad together. That'd be a piece of 3M adhesive would do that. So they've got a variety of different applications. The big end markets for them would be automotive, electronics, general industrial, consumer, and safety products. Those would be
This is old-fashioned industrial stuff.
I mean, if you think about what drives 3M's demand, and I get asked this by a lot of investors, it's global IP. If global IP is growing 2%, then 3M will grow 3-4%.
Okay.
It's really that simple.
So why is it doing better these days?
So the best is, in many cases, I mean, obviously you've got to catch the tide of end markets. So when you got like a data center boom, you got to catch that wave. But I'd say some of the best stories in industrials of my career have been CEO change, margin improvement stories. And that's effectively what 3M is here. So we had a period of time where I think the company was captured by external events. There was a lot of legal liabilities, a lot of concern around PFAS liabilities and other things. And I do think that really affected the company's culture. And then Bill Brown comes in, and Bill Brown was retired. He was a very successful CEO. He cut his teeth at United Technologies back in the day, and then he became CEO of L3 Harris.
We did a great job.
And created a ton of value.
A ton of value.
I mean, amazing. So he had a huge reputation. Look, he's been in the job for a year and a half, but he's laid out a very credible plan to improve margins, to accelerate growth, and they're cutting through the liabilities as well. So creating a lot of value.
Let's talk housing a little bit. Housing sucks.
Yeah.
What are you hearing from your companies? Is there any hope? You got Stanley Works. You've got some companies that do HVAC for residential. Like, what are these companies telling you?
It sucks. I mean, it doesn't feel like there's a whole lot of visibility right now. We're underproducing housing. So I don't know what numbers you have for the natural.
We're like 3 to 5 million homes short.
Right. And we're continuing to underproduce every year. So it's a conundrum. But right now, I'll give you one data point. The residential HVAC industry, so the supply of air conditioning units to the residential market, end market demand for that industry is down today 10-15%.
Wow.
Year over year. And this is an incredibly stable industry over time. So we're going through a big correction in that end market. I'd say in general, most building products end markets are probably down low to mid-single digits right now. So I would hope that in 2026 we'll see some recovery in demand. But right now, I think the companies are telling us, maybe flat next year.
They're hoping.
They're hoping for flat next year.
For flat from down to 10%.
So for example, Dave Gitlin, a Carrier, was at a conference recently. And he said his plan assumption for next year is flipping from down 10% this year to probably flat next year.
So flat from down 10%.
From down 10%.
Which is pretty bad when you think about it.
Yeah.
If you had to, let's talk about the distributors for a second. You got Grainger, you got Fastenal, you have an underperform on each. How come? So
distributors, their function is to effectively be the intermediary between the manufacturers and the end customers. And what we're seeing right now, there's a lot of gross margin pressure for the distributors. And in the case of Fastenal, they have yet to see the tariff inflation hitting their P&L. So we have concerns that effectively gross margins will be down for them next year, which given the valuation would be a negative for the stock. So that's why we have an underperform there.
All right, let's take a step back, relax. Let's go back in time. Your best call ever, your worst call ever.
So
now, believe me, I was a sell-side analyst. I had plenty.
Yeah.
So what would you say your one or two best calls were, and what were your one or two worst calls that you've made?
So I think my best call was probably Vertiv, which was about 3 years ago. We spotted the margin issues in 2021, so we downgraded the stock in
what were the margin
December
issues?
2021. They were having problems with the supply chain. So if you remember back in 2021,
you couldn't get anything.
You couldn't get anything. Right. And what was happening was the chip companies were prioritizing their larger customers. And
they were what?
Prioritizing their larger customers. So they were rationalizing supply. And it seemed that Vertiv maybe was on the wrong side of that line. So they had some issues with that. And anyway, so we downgraded on margin concerns into 2022 at that point. And I
remember it blew up.
And they blew up. It was I think the stock was down 45% on the back of 4Q22 earnings.
Oh, it was unbelievable.
It was unbelievable.
Cody was tremendously embarrassed.
And honestly, he actually took full ownership of that.
Did he?
He absolutely did.
What did he say?
He basically apologized on the call and acknowledged some of the issues and how they'd fallen short and committed that this would never happen again. And they laid out a play-by-play for how margins are going to recover through the year. And by and large, it played out. So
so you believed them?
No.
You did not believe. No. So your good call was that you downgraded it.
Well, we downgraded before that.
Okay, beforehand.
This was a trust but verify situation.
Okay.
So we were warming up the story, and then towards the end of 2022, this was December 2022 at this point, we were seeing a big inflection in data center demand in the US. We've seen a big upward inflection in starts. And Vertiv is the largest supplier of infrastructure to the data center. So we thought, okay, they've done a good job of recovering margins. There's still some way to go here, but this demand inflection is going to be a positive
So you
stock.
recommended it.
So we did. The stock was $13 and it's now 180.
Yeah, no, great call.
Thank
you. Give me another good call.
I think 3M, we had a sell in the stock at, underperforming the stock at 250. And
me too.
Yes, I know. I remember we had a conversation about this, and we upgraded the stock at about 90. So as you know, short calls, spotting underperformance is much harder. Mm-hmm. So that was probably my most impactful sell. It's now one of my better buys, quite frankly. So you have to be flexible with stocks. The
bad calls.
The bad calls.
Everybody's got them.
Yeah, I would say we were big fans of, probably on the long side, I think United Technologies. I was always a huge fan of that company. They had great brands, Otis elevators, Carrier air conditioning, Pratt & Whitney engines, and then you had a great aircraft systems business. There was a huge amount of some of the parts value in that business. It was always very, very cheap, but the stock basically underperformed for 10 years.
And why do you think it underperformed for so long?
Just had, number one, it was too complex for a lot of folks. And they just had execution issues with the GTF engine. There are a variety of things. And it was the classic example of how separate standalone companies are better than
conglomerates.
Exactly right, yeah.
Okay. Let's talk about politics just a little bit. You've got a president who's trying to bring factories back to the United States. In the bill that was passed in May, you get to write off all of your capital X if you build a factory in the United States. So, the policy of the United States is to try and bring as much back of the supply chain as possible. Is there any evidence at this point that that's working?
I'd say qualified yes. It's not blindly obvious, but if you look at if you look at the manufacturing investment today, per the government stats, the Census Bureau, manufacturing spending today is running at $250 billion a year. 5 years ago, it was running at under $100 billion. So it's up by more than 2x. So there's
when was it $100 billion?
Go back to 2019, 2020.
Okay.
At that kind of level. It's about $80 billion or so, $100 billion. Now, a lot of that is the semiconductor fabs that are being built out west, but it's also life sciences, plants, a lot of wastewater plants as well. So there's, so I think that there is money being spent. I think if you looked at some of my companies, they are seeing a lot of large project activity happening. If you look at the Dodge Momentum Index, which is an indicator for larger projects under planning, that's off the scale strong. So I think that there is some signs here of activity, but again, it's not blindly obvious, and I think we need to see more evidence of this. But I think there is some signs.
So what do you think of your group going into next year? I mean, it's kind of a K-shapey economy. If you were sitting with an investor right now, what would you tell them to focus on? What would you tell them to worry about?
So our view, our published views, and are that data center AI remains very strong. So that's where the growth is going to continue. I think the question is that after many of these stocks being up 100, 200, 300%, how much more upside is there to the multiple? But certainly data center AI is going to continue to be part of that barbell. I think most investors, and certainly our view, is that it's probably too soon to weigh into the consumer and residential housing at this point in time. I think we need to have better visibility on the rate reduction cycle, the Federal Reserve easing cycle. So I think that remains probably kind of a story for maybe second half of next year. I think the big question mark for a lot of investors is short cycle industrial. So some of the more cyclical industrial sectors.
Like whom?
Rockwell Automation, Parker Hannifin, 3M would fall into that category as well. And we've had not a whole lot of growth in that part of the economy. And are we going to see the ISM, the ISM index back above 50?
Where is the ISM index now?
It's been sub 50 for 3 years now.
3 years.
So right now it's about 48.
So short cycle's been tough.
It's been very tough. It's been stagnant. It hasn't been terrible, but it hasn't been growing. So it's just been in this holding pattern now for 3 years. Now, why is that? Now, could it be, tariffs have been a headwind. I think the election uncertainty has been a headwind. We've had pretty tight conditions in the economy. I mean, real rates have been quite high for some time. So I do think we need to have some easing from the Federal Reserve. But that's the big call to my mind is, do investors want to get more cyclical in 2026?
If I had the view that in the second half of next year, housing was going to get better and there would be growth, what would be the two stocks in your sector that you would own? So
the two stocks that would have the most leverage to that inflection would be Lennox International, ticker symbol LII. 90% of about 60% of their business is tied to the residential housing sector. And then Stanley Black & Decker, and effectively
power tools,
hand tools. 80% of their sales are tied to the housing sector.
So those two?
Those would be the two, yes.
Okay. Nigel, that was great.
Thanks, Steve.
Thank you.
That was a lot of fun.
Great.
Thank you.
Thank you. Thanks for coming.
Thanks.
This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.